Hey YouTube, what's going on? It's Patrick here at VectorVest bringing you another update on GME, especially after yesterday's hearing that we had about the whole GME fiasco from back in January. We've got some speculation to talk about and some potential ideas on what could help settle these fears and help bring retailers back on track and par with some of the big institutions. Also, if you weren't aware, we are trying to help raise money right now for the Diane Fossey Foundation. So check out that video right here. So if you're ready, hit that like button, hit that share button, hit that subscribe button, and let's go ahead, jump right into it today. All right, welcome back to another GME update. Right above me, I've got some of the key responsibilities for market makers. If you're not already familiar, some of the key responsibilities are determining the accurate prices of stocks, also price discovery, so essentially figuring out where that supply and demand axis really meets, and also help provide liquidity to markets. There was a lot of insight coming in from yesterday's hearing on the GME fiasco from back in January. And a lot of new speculation has arisen from that. One of the key things that has come out of this is talking about the margin requirements that Robinhood had to deal with when GameStop was exploding to the moon. Well, there's a lot of speculation that people who bought GameStop or AMC or any of these meme stocks never actually owned the shares of those stocks in their Robinhood accounts. And so therefore, Robinhood was borrowing those shares on margin and putting IOUs into their users' accounts. And that's when they got hit with the $3 billion, I believe it was, margin call. And that's why they stopped trading. Now, there is, once again, a lot of speculation with this. And until it has been proven in a court of law, we can only consider it as that, speculation. So once things change or once we finally get some actual answers, then I'll definitely be doing an update on that. But for right now, this is all going to be classified as speculative analysis on what's going on. So now we've gotten that out of the way. Let's talk about it. So with this whole thing, when they are borrowing those shares on margin and loading them out to you and you're buying them long, that essentially puts them as a short seller against the stocks that they have in your account. This seems to be a clear conflict of interest with this whole situation. Robinhood was designed to democratize finance or democratize investing, however they want to word it. But when it all comes down to it, it looks like they were actually just simply utilizing their users to sell to these hedge funds or these market makers, these high frequency trading market makers. One of the other curious parts that has sparked my interest is how this exactly worked, and it sounds like it's more of a contract for difference rather than an actual brokerage. Now, if you're not familiar with the term contract for difference, essentially that's just saying, hey, I want to buy this stock. The market maker, the brokerage, for in this case Robinhood, says, okay, your price is whatever it's trading at the time. They expect you to lose money, so they never actually go out and buy those shares to put in your account because they expect you to lose money. And then when you close out of the trade with a loss, then they just collect the difference. Now, typically this is okay for them to get away with if this is actually what's happening behind the scenes, because either if the stock does go up and you close out with a profit, then they just pay you the extra out of their pocket and they never actually held the shares. This is technically illegal in the US. And if this practice comes to light as what is actually happening, this could cause a lot of issues, especially with them wanting to bring out their new IPO. So that is one thing that we definitely need to keep an eye on for, and I'm definitely going to be paying attention to in the hearings coming up or as this story develops. Another area of speculation that's come to light is that these IOUs that they're placing in your account, when they are fulfilled, those orders are coming from dark pools, essentially institutions trading with institutions and not going through the DTC. This would allow the DTC, which is the main regulatory body that watches all of this would allow these institutions to keep it off the books essentially, and that way it doesn't actually have to be traded on the market because they're not buying it through the major exchange. They're buying it from one of their buddy brokers over on the other side of town. What this does is helps manipulate the price of the stock and keeps it artificially low. And this really seems to be another conflict of interest for market makers because, once again, as you can see right above me, the whole purpose of a market maker is to help with price discovery. If they're artificially moving that price lower or keeping it low to benefit them, they're not following one of their main responsibilities. They're not helping identify price discovery. They are artificially manipulating that price to keep it benefiting them. Now, recently, the Robinhood app has updated their payment for order flow contract to where they actually get a percentage of the difference in the spread. This means that for Robinhood to make more money now, they have to appease the market maker rather than their customer base. This does not seem like a sustainable practice and seems like there needs to be some type of investigation, some type of research done into this to identify how this actually benefits the user. Yes, they get free commission trades, but does that really mean the trade itself is free? Could they be actually losing out on some of their potential in a trade because their trade is being given to a person betting against them? Well, this is what we're looking to find out hopefully in the very near future. So with all of that being said, what does this mean as a retail investor? This is just proof that there is a lot of manipulation going on in the stock. Now, how exactly it's all working is up to anybody's guess. But hopefully over the next month, 2 months, however long it takes, we can finally get some answers and really see what's going on and see if these market makers are living up to their responsibility of price discovery. And now with that, one of the things I would like to see going forward, especially with the case of GME and their earnings report coming up very soon, I would like to see these shares of GME be recalled or audited, however you want to word that, so that way they can find exactly who owns shares and who doesn't. There's a lot of speculation out there that the majority of shares being traded right now are synthetic shares, meaning that they're not actual real shares. And therefore, if people are trading those or shorting those, they are naked shorts, which is potentially illegal depending on who's actually holding those. And so to get this whole thing under control and to see the real full potential of what is going on with this trade, I would love to see GME announce during an earnings call or some point very soon an audit of their shares to account for where their shares actually are. So if you hold shares at GME, if you want to see them recount their shares so that way we can get a clear picture of what's really out there and what is fake and what is not, leave a like on today's video and let me know your thoughts about this in the comments below. So until next time, take care, adios, see you guys on the moon.